Hello, everyone, and welcome to another episode of Coffee with Carl. I am your host, Carl Zoellner, one of the attorneys with Anderson Business Advisors. And today I wanted to talk about the 121 exclusion. So there's been a few questions coming through about this, so it's a good time to chat about it. It's a really neat code or a neat provision in the tax code, and I myself have taken advantage of it before for a house I used to live in, or when I lived in Texas while I was in law school. What Section 121 does is allow us to exclude the gain from a sale of a personal residence, and we can use the rules and manipulate the rules to be able to benefit us in a few different ways. And you see this strategy show up in several of our strategies, depending on if it's appropriate for your circumstance. First thing I want to look at is the actual language of the rule. The language of the rule states that gross income shall not include gain from the sale or exchange of property if during the 5-year period ending on the date of sale or exchange, such property has been owned and used by the taxpayer as the taxpayer's principal residence for periods aggregating 2 years or more. Okay, let's unpack that a little bit. So what does that mean? So measuring from the date of sale, if you used at this residence as your principal residence for 2 of those years combined, or however out of those 5 years up to the 2-year period, then when you sell that property, that the amount that can be excluded from that property is not taxable to you. So the next logical question is, what is that amount? So for an individual, you'd be looking at $250,000 that could be excludable. And for a married couple, you'd be looking at up to $500,000 that could be excludable. So you can see why this would be beneficial, especially if you've lived in your house for a while and there's been some significant gain. There will be the ability to set some of that aside if it's your personal residence. Now, you'll see this integrated in a few of our different strategies. And like I said, it depends on that you've lived there for 2 years. But say lots of folks come in, or several folks have come in and said, well, I had this flip property, I flipped it, market changed, so I decided just to move into it for a couple of years before I sold it. Great, we can use that strategy there. Many of you have seen Clint's video on selling your personal residence to your S corporation. This is a piece of that strategy as well, meaning when I sell my personal residence to my S corporation, I'm retaining my 121 exclusion on the gain, and I'm able to reset that depreciation schedule since the property's changed owners. So you can see there we use it as well. The other way you can use it, and I'm looking at you, California investors, if you've had a lot of appreciation, say in your personal residence, but now you're considering moving states, or that you'd like to actually take some of that equity in that property and reinvest it or potentially exchange it so you're not paying taxes on it. Now, when I say that, what I'm getting at is you can combine this 121 exclusion with the 1031 exchange, and you can take advantage of both of those provisions of the tax code, which can be extremely valuable, especially if you're a real estate investor. Scenario works out a little something like this: is going to sell my personal residence. I know I'm going to sell it. I try to make a good faith effort to rent the property out, therefore meeting the investment standard on the 1031 exchange. I then exchange the property, retaining my 121 exclusion because I lived in it for 2 of the last 5 years, and I'm able to exchange that residence into, say, a couple rental properties someplace that's far more cost efficient, let's say, than California. So you can see how we can use these code provisions together in order to get a maximum benefit out of being able to use the 121 exclusion with other solutions. However, if you're just looking to sell your personal residence, you of course can still use the 121 exclusion. It's going to be an individualized basis on which portion works for you and what your specific scenario is. So as always, I would suggest, if you don't know, give us a call. You can, even if you're not a client, the first consultation is free, so you're more than welcome to meet with one of our advisors here, that will set you up with a wealth planning blueprint, and we'll see what works for you. If you're already a platinum client, awesome. You can call in, speak with one of the attorneys, and we can sit down and go through some scenarios with you as well. So lots of solutions out there, lots of different knowledge out there. What you really want to do is focus and speak with somebody who knows what they're doing in the market. So if you are, like I said, if you're not a client, you should be one. If you already are, awesome. Please take advantage of the services we offer and all the free content we have online, so we can help you put your ducks in a row to make sure you're not paying too much in taxes and you're able to hold on to what you've spent your time, effort, and money on building. So like I said, please, anybody out there, you're more than welcome to take advantage of all the content we put out there. We encourage you, if you've not been to one of our live classes, our tax and asset protection classes, that you go to one. It's a great place to get a quick rundown on all the different items we talk about, offer, as well as some unique tax and asset protection strategies that we've come up with over the years. So until next time, we'll be signing off. This is all I had prepared for this episode of Coffee with Carl. We went a little bit long today, but I invite you to make sure you keep joining us for Coffee with Carl, and I'll catch you on the next episode. Thank you.